This case study article discusses numerous losses that were incurred on February 26th of this year on the ASX 200. Shares from firms in various industries were down, with the exceptions of Wesfarmers and Qantas. These numbers and facts are not necessarily representative of how these individual stocks or the ASX itself performed over the past week, month, quarter, or year. Some might argue that the facts presented in this article prove the existence of a two-speed economy. A two-speed economy is where industries experience different levels of growth. This can also apply to different territories or areas which often have different sectors and industries that are more prevalent, such as the financial industry in Sydney or mining in Central and Upper Australia. One could argue that the airline industry is increasing in value while industries such as energy and financials continue a downward slide. However, this article only discusses the activity within 1 or 2 days at most. If one looks at more long-term statistics, they will notice that financial stocks have been relatively constant, and energy has actually experienced the highest increase of all sectors over the past year. A two-speed economy is defined by marked growth patterns that are demonstrated over time. This makes it difficult to determine whether a two-speed economy is at work according to the information that's only available in the article. In 2008, scholars and columnists argued that Australia was experiencing a two-speed economy due to the resource boom. This caused territories in which mining was a principal source of business revenue to boom, while other sectors, such as services and financials, were growing at a much different rate across the country. Between then and now, many analysts have begun writing about the cause and effect of having a two-speed economy. An article from the Daily Reckoning claims that over 60% of the ASX's value is tied up in bank and mining stocks. This means that when these sectors suffer, or even a particularly large business suffers, so does the entire index. This partly attributes, and has partly attributed, to the ASX's slow growth when compared to the United States S&P 500. This is especially notable over the past year. Recent articles discuss the financial boom that is currently occurring in Sydney. Housing and construction are both growing exponentially, which has had a positive trickle-down effect in other sectors. Household spending is increasing, and Sydney's disproportionately large financial sector is also seeing the benefits of these trends. Overall growth in Australia and the ASX has been positive since the publishing of this article. The ASX 200 closed at 5,119 on March 16th. This is a marked improvement from the 4,880 on the day the article was written. So this improvement has occurred over a 2-week period. Looking at sector-specific trends, one notices that the resource sector experienced a stark fall from its rapid growth pre-2009. In 2009, it lost over 50% of its value in a 9-month period. It has since dropped below that point and appears to be in a steady decline. The industrial and mining sectors also dropped in value in 2008, but have been steadily climbing since. It's worth noting that the financial sector has demonstrated one of the most quickly accelerating values in the entire economy since its massive drop in 2008 and 2009. An article in the Financial Review discusses specific stock fluctuations and their effect on the ASX 200. Philip Baker, an Australian financial and share analyst, claimed that if it wasn't for the 27% drop in share price for BHP Billiton and the 13% fall in ANZ, the major index would be essentially flat for the year. This demonstrates the earlier point, which discussed how bank and oil and mining stocks, can have a disproportionately large effect on the index. These companies in particular hold very large market shares, and so their gains and losses are felt more strongly within the index than smaller or even slightly smaller companies. Oil prices have played and do play a major role in the drop, which illustrates their importance to the Australian economy and their effect on the index and, of course, BHP Billiton itself. Bank stocks are usually quite closely aligned with the market itself. CBA, for example, has a beta rating of 1.01. This means it is almost identically as volatile as the ASX 200. Many academics attribute banks and the financial industry's close alignment to the market to the diversity of the portfolios held by the banks themselves. As financial experts, they diversify their asset holdings and take only systemic or portfolio-related risks. Their assets are well spread across different sectors and industries and based on trends and information that may not be available to other people in different industries. This leads to the question of diversifying and managing risk in a two-speed economy. Rapid growth in certain sectors can drive up inflation, which in turn drives up interest rates. This can have negative effects on businesses within the slower growing sectors. The higher interest rates make it more difficult to borrow money in order to finance the development of their businesses and remain competitive. A report by Goldman Sachs discusses how the 2008 financial crisis also affected sectors' growth. New regulations that were introduced post-2008 have made it more difficult for stagnating or smaller sectors and businesses to obtain financing. This is an obstacle to value creation and driving up share price and can have adverse effects on the stock. Tracking stocks' beta ratings is an important measure in determining investments, especially for risk-averse investors. These investors should acquire stocks that have low beta ratings and are therefore far less volatile than the market itself. Stocks in retail have notoriously low beta ratings. Woolworths, for example, has a beta rating of 0.7. This means that they are extremely low risk by comparison for investors, even within a two-speed economy. The downside is that the smaller risk means that they will experience smaller gains in value. Noting the standard deviation of a stock is also useful in avoiding risk, as lower deviations will produce more predictable yields on investment. Though the same holds true as it does for the beta rating, where if the standard deviation is typically higher, then that stock has potential to produce much higher returns. Over the past year, the highest performing stocks in Australia have been well spread across different sectors. Blackmores is a manufacturer of vitamins, natural supplements, and other nutritional products. They experienced an increase of over 250% in value over the past 12 months. Energy stocks, such as AGL, have also seen relatively high increases in value due to higher energy costs, higher energy use, and the expansion of energy networks, especially through rural areas. Investors who allocated assets within utility stocks experienced the best returns over the past year. The sector was up almost 20% in the calendar year. The housing boom in Sydney is also responsible for improvements in other sectors and overall consumer spending. When the housing market improves, so do the service sector and virtually any business that benefits from increased regionally relative spending. In this case, it would be within Sydney and other areas nearby in New South Wales. In conclusion, two-speed economies can pose portfolio risks for investors because they can cause increased interest rates and perpetuate the slower growth of weaker sectors. These risks can be managed through appropriate diversification and properly noting the standard deviations and beta scores of various stocks and bonds. This will allow investors to produce more predictable returns when the two-speed economy is creating predictable and sometimes unpredictable levels of growth. Seeing the difference in growth patterns between sectors within 8 years is demonstrative of this. 2008, it was resources. 2016, it's financials in Sydney and utilities across the country.